Okay, now go ahead and start the webinar. Okay, welcome everyone. We're thrilled to have you here at the SuperCrowdHour this month. Okay, now go ahead and start the webinar. Neiss. We're so excited. And really, this is going to be a great, great session. So thank you very, very much for joining with us today. This is, we're going to be talking about this milestone that Woodie and his firm have marked, which is the $2 billion of funding through regulation crowdfunding. You know, it's a tremendous manifestation of the impact that Woodie has had himself as one of those who was actively involved in driving the passage of the Jobs Act that created regulation crowdfunding. So we are living in Woodie's world, and so it's kind of fun to have Woodie on the show today on the program. I want to thank our sponsors here before we begin. Purpose Rounds is an extraordinary sponsor that they are helping companies at scale use regulation crowdfunding and regulation A+ to raise money from the crowd with a focus on the impact that drives that. And their theory being, and I'm a subscriber to this view that you can actually build a community around purpose, and that it expands and extends your community by having a genuine purpose assigned to your work and your raise. We're grateful for our supporting co-hosts. We have a supporter who essentially donated his support to Rotary, Move the Needle with Rob Kaplan, Amoeba, the American Independent Business Alliance. We've got the Ridgecrest Herbals, Superpowers for Good, and Funding Hope. We're so grateful for the support of all of these folks, including Funding Hope, that a new crowdfunding site that is just launching now. The co-hosts that have supported our work, continue to support it, including the Crowdfunding Professional Association, where I'm proud to serve as the president, the Gig Group, Brainsy, Jenny Casson Group, the Crowdfund Better Mashup Lab, Community Vision Solutions, Crowdfund Main Street, and CrowdMax. We're thrilled and grateful for their support from all of them. We're also grateful. I think it's important as we talk today to remember that I am not, and Woodie is not, a financial advisor. If you want financial advice, I suggest you get that from someone who is. But as we talk about Woodie, I like to describe Woodie as being, one of the real OGs of crowdfunding. He really is someone I look up to, as he was among those who was actively involved in advocating for the passage of the Jobs Act and helped to craft and refine it as it went through various rounds of legislation in both houses, and great bipartisan support signed by President Obama in 2012. He is the principal and chief crowdfunding data analyst at Crowdfund Capital Advisors. He's the co-founder of Guard Inc., a serial entrepreneur. And at CCA now, he works with clients from governments to banks around the world, helping people think through the implications of crowdfunding as an investment tool. So we are extraordinarily grateful to have Woodie with us on the show today, or on the program. Woodie, thank you very much for being here.
Thank you, Devin. It is actually great to be here with you. Devin and I go back quite a few years, everyone. So I think what he is doing with SuperCrowd is so important. The industry, just by itself consists of different players and different roles. But I think one of the biggest challenges that the industry has is the lights going out, is market awareness. And so when you have people like Devin and SuperCrowd out there serving, filling that void in the marketplace, it's just so critically important because this industry is not going to get the awareness that it needs. It's not going to get more eyes on it. It's not going to lead to more investor dollars without people like Devin doing what he's doing. So thank you, Devin, for doing what you're doing.
Thank you. All righty,
and we can
let's get the show on the road here.
Indeed. So do you have is the slides
I'm
up?
pulling up your slides here.
Okay.
All right. Are you seeing the slides like I'd hope?
Yeah, but that's a little the messaging under regulation crowdfunding is just a bunch of boxes. So
there's it got a little garbled. I'm sorry about that.
Yeah.
That I can't fix here on the fly.
Let's go to the next slide for a second, and the next one after that. Okay, so it's fine.
Good,
so just
or
go back to the first one. Yeah. No, we're good.
Okay. Sorry about that.
No, that's okay. Today, my focus is, crowdfunding, and regulation crowdfunding in particular has gone from 0 to 2 billion. The first billion, it took 5 years to raise. It was a slow and steady progression. The next billion took 23 months. And that in itself is a big story because it proves that there's investor interest in it, that issuers are willing to use it, that there's been minimal fraud in the industry, and that it's working. So this is a part of the private capital markets, this alternative asset realm, where we're going to see this growth grow even more over the next few years. I feel like we passed that tipping point about a year ago. And like I said at the beginning, if we've got more awareness as what's happening in this industry, we're going to get more institutional capital in place. And I think that's key to actually scaling it. So if you go to the next slide, let me just tell you a little bit about where we fit into the marketplace. So we were there at the White House when the bill was signed into law. It was pretty cool to have this idea that we had about, creating an exempt framework for crowdfunding offerings that would allow retail investors into the marketplace to actually turn into a law. We did it in 465 days. To hear President Obama say, it was a game changer. It was the fastest piece of legislation to come through Congress. It was super cool. And our work after the bill was passed was really working with governments, institutions, writing a World Bank report, working with the Inter-American Development Bank, and being consultants to the State Department to travel around the world. So my business partner, Jason Best, and I got to visit 53 countries, if you can believe it, talking about the opportunity that regulation crowdfunding presents, not in terms of access to capital for issuers per se, but how this could distribute wealth for investors, particularly for retail investors that have been precluded from this marketplace forever. But it does much more than that because it's a jobs engine. All of these startups eventually hire people to help scale and grow a business. That job engine is really important to local economies. It's what governments really are interested in. But it's more important than that because as companies grow and scale, they buy products and service, cost of goods sold, all of that stuff. And most of those purchases take place locally. So when you look at each of these local businesses that are raising money, they're actually spending money and supporting local economies. And that's a really critical part of it. So CCA sits at the intersection of 3 major themes right now. The first is data, the second is venture capital, and the third is liquidity. And so the first thing is with data, we built the industry's first data aggregator called CClear. We collect up to 125 data points on every company that's raising money online, which allows us to see a lot of insights into what's happening. It's not just the well-being of a company, how they're growing over time, because companies that do a follow-on round of financing disclose their financials. If they file their annual report, we get to see all their financials that way as well. But we can learn about their valuation growth over time. We can see where geographically companies are out raising money and investors are putting money. We can see industry information, so we can see which industries are hot right now. So that's the type of data that we have in our data set. We've got over 500,000 data points related to that. There's over 6,500 companies, 7,400 offerings in that data set now. And that is just powerful in itself, which leads to D3VC, which is our venture capital arm. So because we sit in front of this data and it's like a crystal ball and we're looking at it all day long, we see these companies are like, that's a really fascinating company. Wow, they got a really strong team that's actually been in this industry before. And this is another take on what they're doing. They've actually raised millions of dollars before. We should really follow what these guys are doing. And it was that sort of thinking that had us come up with the idea that, well, why don't we take all the data, sit down with some PhDs that know data analysis, and build a machine learning AI algorithm that will look through the entire data set for signals of companies that have been successful. So what does success mean? Well, they've gone on for a follow-on round of financing, they've exited and gone on for VC financing. Whatever those exit patterns are that lead to that follow-on, we want to see what the signals they had that led to that. And then as new companies come in, we train the algorithm to look for predictive signals or similar type of signals within those companies that are coming in to see if it matches. And we built that algorithm over 18 months and tested it. And now we launched D3VC, which is, like I was saying, our venture capital arm. So every week we get this predictions list of companies that are likely to go on for follow-on round of financing or exit out of the system, which means that hopefully they're going to go on for higher valuations. And we will do our human layer of diligence on those companies and invest in those companies. And that's D3VC. Now, the third thing that we do is guard, which is liquidity. So if you're buying stocks in a private company, you really have to sit on it until there's an exit, a sale, or an IPO. Well, an IPO might never happen or to be way down the road. So most likely, these companies are going to merge with another company or be sold to another company. But you might not want to wait for 7-10 years for that to happen anyway. Part of the changes that took place in the Jobs Act allow companies to now list their securities on what's known as alternative trading systems so that investors can have some sort of liquidity out of those securities. But you can't do any of that unless those securities are either registered in the states in which they're offered and sold, listed on a national exchange, or have an exemption from registration. Well, most of the exemptions require that you do it not in a public setting and you have ongoing disclosures about the company's well-being. That sort of system didn't really exist for private companies to publish their financial information, so we built Guard. And Guard is really an adaptation of the CClear database that collects data points that companies need to provide on an ongoing basis so that they can give investors the most updated information on the company. So if the issuer or the investors want to list their securities on an alternative trading system, the people that are buying those securities can see how well the company's doing. So Guard's a fintech company that publishes ongoing disclosures that keep these companies compliant with the exemptions that allow retail investors to buy these securities on ATSs. So we sort of have our hands on a lot of different things, but CCA sits at the intersection of that right now, and we do a lot of education like this for the marketplace. So let's move on to the next slide. Okay, so some of the key topics that I want to go over is everything that happens at a macroeconomic level affects what happens in the private capital markets. So I wanted to sort of just briefly talk about the timeline from 2016 to the present so that you can see what's behind all of this that's sort of shaping what's happening. I want to do a comparison to what's happening in the Reg D offering space because that's what most people are used to, and show you how the most recent macroeconomic events have had an impact on Reg D offerings. Then I want to talk about really regulation crowdfunding and show you how it's been resilient despite what's happening at a macroeconomic level and it's scaling. We're going to talk about the number of checks that are written. We're going to talk about women and minorities. I'm going to talk about a bunch of different things that are sort of impacting the marketplace in terms of average raises, economic impact in local communities, and then I'll wrap up with some conclusions. So let's move on to the next slide. Okay. Like I said, I'm not going to go into all this, but between 2016 and today, quite a few things have happened. Mainly, we've had a pandemic that was in 2020. Everyone was at home and people were in front of their computers. And interestingly enough, this was a peak where we saw the most activity for regulation crowdfunding. Then we have this period of, supply chain issues. We've got inflation that's coming after it. The Fed's increasing rates. We've got Russia invading Ukraine. We've got this back to work thing. And then in 2023, we've got the collapse of Silicon Valley Bank, this complete geopolitical unrest that's taking place right now. And it really does have an impact on the marketplace. So 2016 to 2020 was a nice progression upwards. Then things really collapsed however you look at it from a Reg D perspective, but it's been sort of resilient from a Reg CF perspective. All right, so let's go on to the next slide. So what happened in Reg D? So like I was saying, leading up to 2022, when we had the supply chain issues and hyperinflation and all that stuff, the markets were great for Reg D. So we were working in parallel with them. People, if you had access to venture capital or angel groups, this was a great way for you to go out and raise money the traditional way. And that's what most companies were doing. The amount of pooled funds that were raised by VC groups was incredibly high, and the number of issuers coming into the marketplace was growing. Then, as if you follow the private capital markets, at the beginning, it was like Q3 of 2022, VCs just shut the spigot off. They held on to all their cash. There's about $2 trillion, by the way, sitting on the sidelines right now. And they're like, we need to wait and see what happens with the marketplace. We need to see what happens with hyperinflation. We need to see if these supply chain issues are going to affect our portfolio companies, if they're going to go out of business. So if they're going to go out, we need to be able to have that cash on reserve to help keep them afloat. So all this investing activity that was happening in the Reg D marketplace really shut off. And you can see that in this chart right here. The seeds of it are starting to come back in terms of activity. So we might have seen the worst of it in Q2 of 2023, but we have to wait to see how even these current events that are taking place over in the Middle East will play out into this marketplace right here. All right, let's go on to crowdfunding. So crowdfunding has just been on this sort of steady, easy incline growth. What you're seeing here is the number of companies, otherwise known as issuers, coming into the marketplace doing what we call offerings. So a company can do one offering, they can do a follow-on offering, so they can do parallel offerings, but we're just counting the number of new offerings that are taking place within Reg CF over time. And you can see that despite what happened with Reg D and the collapse, we saw a small contraction take place between Q3 2022 and Q4, and then even with Q1 2023. And now what we're in Q3 2023 is we seem to be out of it and moving up again. So the number of companies coming in is growing. I think by default, what is happening here, part of the story is if the Reg D side of the market has sort of collapsed or contraction, been under a ton of pressure, however you want to refer to it, companies still need capital. So access to capital doesn't disappear just because that side of the market shuts off. So I think what we're seeing is this migration of companies that are coming into the Reg CF space that are like, listen, I can't find capital through the traditional routes that I was using before. What avenues and opportunities are available to me? And regulation crowdfunding, now that they moved the cap from 1 million to 5 million, really is becoming a good opportunity for more established, less risky type of businesses. And I think that's an important thing to bring up as we look at this as well. When the industry got started in 2016, I would say that about 40% of the companies were post-revenue established, meaning they were over 3 years old type of companies. Those are like your less risky type of businesses. Over like 60% of the time were your pre-revenue startups. So they're less than 3 years old. They had zero revenue. That's like the riskiest type of company or phase of a company out there. And we've seen this flip since 2016. Now, I would say 60% of the companies that are leveraging Reg CF are post-revenue and established issuers. Actually, if you look at the average revenue of these companies, it's about $1 million. So they're not, companies that are looking for the first customer. They're not companies that are proving that there's a business model that people will actually buy into. They're out there. They actually have a solid business model. They're making money, and they need more money to scale. So I like that part of it. because it takes the risk out of the model, not all the risk, but it's letting investors see more established companies coming into the marketplace. Now, what you can see in that line at the bottom is the count of new offerings with the maximum offering amount over $1 million. So again, this speaks to that side of the story, which is more established issuers are coming into the marketplace. They need more than $1 million to achieve the milestones and goals that they've set forth. And we're seeing that in the data. So this number is growing. Like I said, the risk profile of these companies is changing. And I think that is good for the industry because it takes a lot of the risk out of it for the investors in the marketplace. And I also think from a regulatory perspective, to have regulators see that more sophisticated companies are coming into the marketplace is just good for the industry as a whole, because they're going to see it's less risky for the investors that they're trying to protect as well. So let's move on to the next slide. And here we're talking about capital that's been raised by these companies. So the line is the count of the offerings that we saw on the previous slide. Now we're looking at the capital. So, it was very little and slow in the beginning. And then we sort of hit this, breaking point in about 2019 where capital really started to flow in. And it hit a peak in what was happening during COVID, where everyone was just in front of their computers and people were really interested in making sure that businesses they know, people that are entrepreneurs that they believe in, had the capital that they needed to survive. So, that peak period of COVID and through COVID, before the vaccines were really part of what was happening in the marketplace, I think is seen in a lot of these peaks that we're seeing there in 2020 and 2021. Then, of course, the same things happen. We have the supply chain issues. We've got inflation coming into the marketplace. We've got the Fed increasing the interest rate. All of that makes investors a little jittery. So there could have been a pullback in the number of investors that we've seen over time. But clearly, even though there's been a pullback in the number of investors, the ones that have stayed in the marketplace are still writing sizable checks, which is keeping this average dollar amount pretty high. So Q3 just ended. We projected it to be about 127 in this deck, but I think it ended closer to like 134 for the quarter. So it's higher than our projections, but we're still off from the highs that we've seen in 2020 and 2021. And I believe it's just a matter of time before we get back up to those highs again. Okay. But this also paints that picture of why did it take so long to get to that first billion? Well, market awareness. People didn't know what's going on. These initial platforms were building traction and all that stuff. Now we've got established platforms that are in the marketplace. I would say that WeFunder, Republic, Start Engine, Seed Invest isn't there anymore, but they were the ones that had the most offerings in the marketplace and raised the most money. So it's not really the 80-20 rule where 80% of the volumes done by 20% of the platforms. It's more like 95% of the volumes done by I would say 5% of the platforms. There's been about 150 platforms that have registered with the SEC to facilitate regulation crowdfunding offerings since the industry began in 2016. Right now, I'd say there's averaged about 80 active platforms. But again, of those 80 platforms, you only have a handful that are doing the majority of the volume. We do think that this next billion, so if you're looking at these figures right here, I would say, if Q3 was about 130 something million dollars, it's very likely that we'll be over $500 million again for 2023. And we'll probably get the next $1 billion instead of 23 months. I would say it's probably closer to 20 months or 18 months for that next $1 billion to come in. So let's move on to the next slide. And this is a really interesting one because, you've got investors that are writing checks in the marketplace. You've got companies that are facilitating offers in the place. and you've got the total amount that's being invested. This looks at the number of checks that are written. So this is really, if you consider each investor writing one check, and you look at one of these offering pages and you see the number of backers, that could be equivalent to the number of checks written into that offering. And that's one of the ways in which we track this data. You can see, again, it peaked in 2020, 2021 during COVID. And there's been a steady drop off due to the macroeconomic events. But when you compare this slide to the one that was before, where you saw the money sort of peak up and then sort of flatten, but it's going back up again, this one, it's sort of trending down. So investors clearly are worried by the macroeconomic events. Investors clearly are saying, maybe it's not the right time for me to be in the marketplace right now. I actually sort of like that logic that's built into the system, because maybe the people that shouldn't be investing in these opportunities are staying out of the marketplace right now. And the ones that are left in here and making the investments are the ones that probably have more risk capital and have the ability to write bigger checks. And I think that's what we're seeing playing out here. The number of checks written is dropping off, but we saw in that prior slide that the total amount is actually going up. So that means the average check being written by these investors is growing over time. So fewer people in the marketplace willing to place bigger bets. Now, if you're a company and you're thinking, gee, these political economic events, these macroeconomic events, it's just, is it the right time for me to go out and raise money? That might be keeping certain people on the sidelines. But listen, if you've got a business that's established, you're producing revenue, and you need money to scale, I'd say this is a great time for you to get into the marketplace, because you're not going to be competing with a lot of other companies that are looking for capital. So if you've got a standout opportunity, I think this is a great time for you to be getting into the marketplace to raise money. Okay, so let's talk about the next slide. Women and minority founders. So we tag the offerings when they launch for women and minority founders. So we're looking to see, what percent of the companies that are raising money have a woman or minority founder. And why is this important? Well, traditionally, only 2% of venture capital goes to women and minority founders. There's been complete bias in the industry. It's been built in there and baked in there. If you've been to Silicon Valley, you just know it's a good old boys, particularly white boys club. They talk a lot about changing it, and they've started some funds in order to do it, but with relatively little success. And I think what makes regulation crowdfunding so great is the biases just aren't there. The people that are raising money look like the people that they're raising money from. And because that takes out the complete bias, you're just raising money from your community. But we wanted to see the impact of regulation crowdfunding on women and minorities. So these two tree maps that you see on the left-hand side, the first one shows you the percent of all Q3 offerings that had a woman or minority founder, and the bottom one shows you the percent of all the investments that have a women or minority founder. So at the top, you can see that let's say 59.1% are white males. So 40.9% of all the offerings in the green area on the right-hand side have either a woman or minority founder. So that's great, because like I said, only 2% of VC funding went to women or minority founders. The fact that 40.9% of all the offerings have a woman or minority founder means that the regulation crowdfunding is doing what it was partially meant to do, which is democratizing access to capital, making it so that anyone, despite what you look like, who you are, who you're affiliated with, can go out and raise money from your community. And so I love that part of it, because it shows that the model is working. Now, the other part is it's a little frustrating that the amount of capital, the percent of capital, doesn't equal the percent of offerings of women and minority founders that are out there. So only 28.9% of all the capital that was raised in Q3 went to women and minorities. So again, that's phenomenal in the sense that these people that would not get capital elsewhere are now able to get capital, and that we should, congratulate the industry for, access to capital and doing that. But it's frustrating that they're not getting the same amount of capital as their white male counterparts. And I think that bias is still part of the industry. I think the people that are raising money, the women and minorities that are raising money from investors, the people that look like them might not have the deepest pockets to be able to write the checks that the people that are funding white males. But again, I'm hoping this disproportionate amount of capital to non-minority male founders will eventually shift. And that's one of the things that we're tracking over time as well. We've seen the percent of women and minority founders going up. We are seeing the percent of capital increasing. I will say that when you look at the type of offerings, within regulation crowdfunding, you've got both debt offerings and you've got equity offerings. I would say that within the debt offerings, you find a lot of women and minority founders in those offerings. They're doing, restaurants or personal services type of things, or food trucks. A lot of this is happening on platforms like Honeycomb and Mainvest. I think they're really good examples of these debt crowdfunding platforms that are really making an impact on women and minority founders. And so if you're interested in funding some of them, I would tell you to go to those platforms. On the equity side, I think we see a lot of female founders in the marketplace. We don't see quite as many minority founders. So, I look forward to having more of the women and minorities come in. I think as the industry gradually evolves over time, what happens is you've got all of this taking place, there are about 1,200 cities across the United States where we've had at least one regulation crowdfunding offering in all 50 states. So as awareness increases over time, I think just a lot more women and minorities that are living like in Denver, Colorado, where I am right now, will be able to come online. And so we'll see a gradual evolution and shift that's taking place in the minority in the market that's positively impacting these founders. All right, we can go to the next slide. This is a question that, I get asked all the time, like, what can I expect to raise in my offering? And my answer is, well, it depends on what's happening in the marketplace, the geopolitical events, the macroeconomic events. But this is fascinating because we've been tracking this every quarter over time. And you can see that this past quarter had the highest average raise. I'm sorry, that line should not be average valuation. It should be average raise. And so the average raise was about $650,000, which I think is just really, really powerful right now for those companies that are looking for capital. Again, I would tell you that it really depends on if you're an equity issuer or you're a debt issuer. The debt companies, the debt issuers that are out there raising money on these debt platforms are raising, I would say, about $150,000. So you need to scope your expectations based on that. But these equity raises, given the fact that you're seeing these average raises increasing over time, is a sign that you can raise more, and the ability for you to raise more is just happening by default in the marketplace. So I think that a lot of this is due to the fact that we went from a $1 million cap again to a $5 million cap again. A lot of the work that we're doing in the marketplace is really focused on how do we increase that cap from 5 million to 20 million and bring in more established, less riskier type of companies that can leverage this opportunity. So, I think that's a positive sign. So let's go on to the next slide. Job creation. When we went to Washington, D.C., one of the things that we were talking about is this is a jobs engine. And we're not really talking about access to capital. We're talking about job creation. And because each of these companies, if you're a startup, you start with just you with an idea. But if it turns out to be a successful idea, well, then you need staff to help you scale that business, from marketing and sales, to support staff and everything that it takes. And that's what you're seeing in this chart right here. The cumulative job growth or jobs that are supported through this, we estimate to be close to about 450,000 jobs right now. That's like a 500,000 jobs almost that have been created or supported to based on these companies that have been successful. I mean, show me other areas in the market where it's been able to create this sort of jobs engine the way regulation crowdfunding has. We had this inflection point in 2020, and we're just on the steep incline right now that's taking place. And I think it's just a matter of a couple of years before we're at the million plus jobs that have been created. And jobs are so important because it provides a livelihood for people. It provides salary. That's how we pay certain mortgages. People are buying products and goods. The whole point of this, it's all of these things, the housing market, the job market, the small business market is super important to our economy, because if you don't have people employed, well, then they can't get houses, or pay for the rent. So you need to figure out ways in which you can stimulate startup and entrepreneurial businesses in your local communities so that you can have the job creation and the economic impact that you're looking for. All right, so let's go to the next slide, which is like the key points and really conclusions that I want to talk about in terms of what's happening here. So in terms of this, when we were in Washington and walking the halls of Congress, people are like, this is going to lead to fraud. There's going to be massive business failures. It was just, the fear and uncertainty and doubt, FUD was everywhere, which is why, by the way, I was so focused on getting the database up and running and collecting all the information, because if there's one thing that I believe is data doesn't lie. So if all of these people can freely spread FUD out there without any data to back it up, I wanted to be able to have all the data to be able to destroy their arguments. And that's what we've been able to do. Anyone that says anything negative about regulation crowdfunding, my first response is, show me the data to prove your point. It usually is shut down at that point because they have nothing to prove what they're saying. So I love to talk about the opportunity that exists in regulation crowdfunding just through the data. We've been able to prove the skeptics wrong because we've been able to expand this. We've been able to bring in women and minorities and fund them. We've been able to do this in cities outside of massive money centers like New York, Boston, in LA. And it's just breaking down barriers left and right. And it's distributing access to capital. But I think the other thing that it's going to do is distribute wealth, because people that are investing in these businesses will become rich. And I think those are the type of stories that we haven't heard yet, but we will be hearing more of. Like I said, the evolution, we went from 1 billion to 2 billion. We did that in, the first 5 years and then 2 years. And I think the next billions shortly thereafter. Right now there's about 140 new companies coming online. There's about 5.5 a day. When the industry got started, I don't even think there were 5, in the first day. I mean, in the first, week, I should say. So this is just at that point where we're at a rapid evolution with 150, registered portals, 80 plus that are active. You're just going to see more of this activity going on. And it's not just happening on regulation crowdfunding platforms. One of the things that the law allows is broker dealers to get into space. So in the beginning, we didn't think that there would be much broker dealer activity, but now you've got major broker dealers like Dealmaker and Dalmore in the space. They've been known for private capital markets and doing these offerings, but at the Reg A, the Reg D level, and they can do solicitation for those offerings to accredited investors. But now they're actually looking at regulation crowdfunding as the initial on-ramp for these companies that they believe will go on for a Reg D, a Reg A offering. So they want to capture them at the earliest stage so that they become partners with them through their fundraising life cycle. And I think that's an important evolution that we're seeing in the marketplace as well. Like I said, women and minorities, have benefited tremendously in terms of how the industry is diversifying. But it's not just that, you have to look at the industries that are being funded. When we got to Washington, D.C., we thought, this is going to be beneficial for, tech companies and for, retail, Main Street, cash flowing businesses on the debt side. And since then, I couldn't have been proven more wrong. There have been over 580 different industries that have been funded thanks to regulation crowdfunding. And I think that in itself speaks to, the wide appetite that investors have for what's going on here. It's not necessarily about, a specific industry, but these investors are investing in an industry, but investing in people that they know and believe in those industries. And I think that type of diversity that's taking place is really powerful because, again, these are the earliest seed stage companies that are out raising money, and they will go on and scale to great things. Like I'd mentioned before, some of the driving forces really come down to the platforms themselves. You've got WeFunder, Start Engine, Republic have fueled a lot of this growth. The SEC should be credited with changing the limits from 1 million to 5 million. And their contributions have really empowered entrepreneurs, especially women and minorities, to access capital from more than just a traditional small base. The economic transformation is just phenomenal. 85% of the companies that are raising money through Reg CF are doing it beyond major financial centers, and they're pouring billions of dollars into local economies. And like I said, supporting more than 450,000 jobs. This positive influence just radiates through job creation and local commerce. And I think that is one of the biggest stories that is not really focused on by the media, but that's coming out of this. There are challenges. We've got a lack of media awareness about this. I think that'll change. We have some of these big exits in the marketplace. And there's a lack of institutional capital in the marketplace. And that's one of the, the pain points that we're trying to solve with D3VC is we want to create a pathway for institutional capital to get into the marketplace so that they can invest in this market and diversify among many investments without having to do all of the work that is typically required in a diligence side. The economic effect, by the way, of this money that's being spent by these companies in these local economies is over $5 billion a year. And that's nothing to sneeze at. That is a major economic impact that these companies are having in these local communities, thanks to regulations crowdfunding. So I think the future is really promising. I think we're going to move away from word of mouth awareness to more platform promotion, to more success stories. I wouldn't be surprised if there's television shows that come out that just highlight companies and show investors how they could diversify into this marketplace. I don't think the industry would be what it is if we didn't have successful examples like Boxable. They went from their $42 million valuation in their first offering to a $3.4 billion valuation in their most recent offering, which was a Reg A offering. So if you'd invested $25,000 into that, and that's what we plan on doing with D3VC, that turns into a multi-million-dollar success. That's what we're looking for in here. It's like, how do you look at the data? How do you pinpoint these opportunities and look for winners in there? As the industry scales, as we go to that next $1 billion, a lot of this AI regenerative startups are entering the space. But I believe the seeds for your next Apple, your Google, your Facebook, whatever, are going to happen here in regulation crowdfunding. So it's sort of exciting. Again, I think a lot of our focus is on pushing the SEC now to move from 5 million up to 20 million. And if you can just go to that last slide before we open it up to questions, feel free to reach out to me. My email is sherwood@theccagroup.com. One of the things that we just launched, because a lot of people ask us, what can we get that can help us understand what's happening in the marketplace, is this weekly tear sheet. And so this just gives you a synopsis of what happened each week within the industry. So you can see the change in investments, investors, the valuation changes and all that stuff. And it's just a one pager. So if you go to that URL right there, You can sign up for it and you'll get a weekly update that comes in so you could see. I would just point out, if you're looking at that first one, you'll see Honeycomb in the lower right-hand corner of the tree map has really had a really phenomenal week in terms of the number of offerings. Typically we see WeFunder and Start Engine up there, but the debt opportunity is a real one. I wrote about it this week in our newsletter that went out. So I think there's a lot of opportunity for what's happening in that space. And with that, we can open it up to questions for the group.
Fantastic. Great discussion. Everybody, you can use the Q&A function to submit a question. And while we're waiting for you, I'm going to turn off the screen share here. So Woody can speak directly to us. Woody, one of the things I see with this data that's very encouraging, of course, is your focus on women and minorities and their greater access to capital through crowdfunding. But it is also clear that there's an argument that we're not yet seeing women and minorities getting what I would refer to as their fair share. You can argue about what that is, but I would argue they're not getting it. How do you think we can encourage folks who look like you and me to include a gender and diversity lens in their investing, to be a little bit more proactive about including deliberately a broader range of founders in their investing pattern? How do we do that?
Well, I think there's many ways to do that, but what I'm focused on through the data is showing the patterns of success that women and minority founders have with the capital that they raise. So we track that through their revenue growth over time. We track that through their net income changes over time. And so by taking that type of data and putting out there and saying to investors, particularly ones that look like us, it's not just smart. It's not just the right thing to do to invest in women and minority founders, but when you compare them to their white male counterparts, you'll see that they tend to have a higher success rate in terms of average revenue growth year over year, spending less money and having greater net income year over year. Those are the type of things that we need to get out to investors in the marketplace, so that they understand that it's not just the right thing to do, but it's the smart thing to do.
That's I appreciate that answer, because it really is, I think, the smart thing to do. As we had a question come in from Meseret Warner, and Meseret does a lot of work in Ethiopia. She's a phenomenal human being working on a crowdfunding approach there. She asks, she says the presentation was great. She was wondering if you have a global perspective compared to the US data. What are you seeing globally? You've done a lot of work globally.
Yeah, it's interesting. The crowdfunding growth really depends on how prescriptive the regulation is around it. So we've seen in the UK through our peers over there that they've had a very light touch regulatory to the industry, and it's really allowed it to grow at unprecedented levels. But there's other parts of the country, other parts of the world, where governments just put on a very constrictive approach to the regulation for it. And there's really been not much activity related to it, because if you create a chokehold that overregulates, then it's not going to be good for issuers that want to go out and raise capital, because it's too bureaucratic and cumbersome and costly. And investors really don't want to pay for all that compliance that goes with it as well. I mean, these are small companies. They're much easier to see through than, an Apple or a Facebook or whatever. So let's not overly complex the regulatory side of it. But I think the opportunity is there on a global scale. I think, the part of the next evolution is how do we integrate what's happening with, offerings in Europe to offerings here in the United States, so that if you've got investors that want to diversify and invest in some crowdfunding offerings over in Europe, they can do so without, the companies breaking any solicitation rules on reaching out to American investors. But Europe has sophisticated frameworks for crowdfunding. Ours is much more prescriptive than the UK. So it sort of depends on where you are. But if you've got seeds of it, the key part about it is it's not necessarily always about the regulation, but how do you pull together that group to actually start investing in these businesses so that people can see the impact that those investments have had on these local economies.
That is, I appreciate that insight. And I appreciate you, Woody, taking the time to be here today. Your insights, I think, have been phenomenal, profound. I think it is such an important milestone for us to mark this $2 billion hurdle achieved, and to think about the implications as you've guided us through that discussion is really important and valuable. And so I'm grateful to you, and thank you very much for being here with us today. I want to just take a minute as we wrap up here to share a little bit of information here with you about our upcoming events. I'm excited that we do have some exciting events coming up. Where have I hidden my Zoom?
Well, while you're doing
technology,
that,
technology is
well.
getting the better of me today. Yeah, there we go. Zoom, zoom, zoom. Where have you gone? This is so funny. Where did Zoom go? It's hiding. I can't find it.
But we can still see you. So
let me tell you, you can see me. So I'm going to tell you about our next 3 events, since I can't see anything now. I do Zoom 9 hours a day sometimes, and here I've lost my Zoom. I don't know what I've done. But we've got 3 great events coming up on Monday of next week. We've got a SuperCrowd Utah. And this is going to be a phenomenal in-person event in Sandy, Utah at the Miller Center. So if any of you are watching in Utah, be aware that we've got this great event, 20 plus speakers, many from around the country, genuine experts coming from both local and national experts coming to participate in this discussion. You don't want to miss it if you're in Utah. Next month at our SuperCrowdHour webinar, we'll have another OG of crowdfunding. We'll have with us Jenny Casson, who also worked on the passage of the Jobs Act back in 2012. So it's going to be another great webinar. She'll be talking about how to raise capital on your own terms, how to fund business without selling your soul. And then at the end of November, on November 30th, we'll be in Baltimore for SuperCrowd Baltimore, another in-person event. And we're so excited to have, we've got already a great program coming together. That will be a phenomenal event. We'll be at the B&O Rail Museum. It's a special venue. This is going to be a lot of fun. So please plan to join us for that. If you're on the East Coast in that Baltimore, DC area, you'll find that it's well worth your time to be there. So again, thank you everybody for being with us today. And especially thank you, Woody, for making the time to be with us today. We're extremely grateful, and look forward to seeing you all next month at the SuperCrowdHour with Jenny Casson. Thanks now, everybody.
Thanks, Devin. Thanks, everyone.
Okay, Shannon, you can shut her down.
Thanks, Devin.
Thanks. Thank you, Woody.